One of my more popular recent videos on this YouTube channel was about the math behind making $100,000 each year in dividends. So how much money do you actually need to create that type of portfolio? What are some of the things that can aid you along the journey? That's what that video was about. So I decided to come out with this video because making $1,000 per month with dividend investing is an easier goal to reach for people who want to hit that bigger milestone. So I'll be sharing some strategies in this video you can use to reach your $1,000 per month through dividend investing. If you like the sound of that, make sure you subscribe to this channel. We focus a lot on different ways you can make more money and gain more visibility for your brand. So when it comes to dividend investing, the first thing you have to do is know which type of investor you are. Are you someone who needs the income right away, or are you someone who will wait it out a little bit because you will pick a stock that has more appreciation potential? The stocks with high dividend yields, they're usually high because there's not that much growth that's going to be happening for those companies. You usually see really high yields with companies that aren't going to see too much stock appreciation. But when it comes to a company with a lower yield, there is more potential for growth. At least you would expect to see growth if you're going to take on a lower yield now. So this is important because, again, if you want to hit $1,000 per month in dividends sooner, you want the higher yield stocks. But if you want to hit $1,000 per month, maybe it takes a little longer, but the appreciation completely blows away the high yield stocks, then go for the growth approach. We're going to talk about those two differences right now. So we're going to use two examples to illustrate this point. The first point is AT&T. That's the first stock we're going to look at. That's the type of stock where if you want to make the $1,000 per month in dividend investing quickly, you get that type of a stock because right now it's hovering close to a 7% yield. Now, it is important to note, based on all the stuff that's happening, there are going to be a lot of stocks with pretty high yields just based on what is going on. AT&T has a consistently high yield, but you're not going to get too much beyond that because the way AT&T does its dividend growth, you're going to see around 2% growth each year. They raise it from 50 cents to 51 cents. Then they raise it from 51 cents to 52 cents. So you're not going to see a ton of dividend growth on the AT&T side. And even before the economic shutdown, AT&T stock only appreciated 12%-ish in the last 5 years. So that is, if you're looking for something beyond the yield, you're just not going to get too much from a company like AT&T that has that high yield, but it's a mature company, and that's a big reason it offers that type of yield. And AT&T is one of those stocks that has paid its dividend consecutively for several decades. So as a shareholder, you put money in there and you feel like your dividend is safe. Now, just because a company has paid its dividend consecutively for decades and consecutively raised it doesn't guarantee that trend will continue, but it does offer a good sign. And again, an important thing to note, for a lot of these companies, you do get a juicy yield, but that's pretty much it. Stock appreciation and the increase in the dividend yield, those are going to be very minimal. So you don't need as many shares of a company like AT&T versus another company we're going to get into, MasterCard, to hit $1,000 per month. Now let's talk about MasterCard. MasterCard has a very low dividend, and you may say this is not the type of play you would want to do as a dividend investor who wants to make $1,000 per month. But if you are someone who you're willing to wait a little bit to hit that goal, but you want the stock appreciation, you want the overall return to be higher in exchange for not getting a ton of dividend money right away, then a stock like MasterCard is your play, because you can see that MasterCard has grown a lot in the past few years. And as we go more towards a paperless society, companies like MasterCard, Visa, American Express just only stand to benefit from that movement even more. Now, but even though MasterCard has a really low dividend, it does have an insanely high growth rate of around 20% each year. Now, as a company matures, it's not able to do that as well. But with MasterCard having a really low payout ratio, which basically the lower the payout ratio is, the more sustainable a dividend is. But with a low payout ratio, its ability to really raise its dividend and the stock appreciation, it definitely takes a lot longer to hit $1,000 per month in dividends, but you do get the overall higher return. So where does that leave you as a dividend investor? Well, AT&T and MasterCard are two extreme examples of an income approach versus a long-term growth approach. But there are a lot of stocks in the middle where you can find stocks right now at around 2 or 4% yield that are raising their dividend at around 10% each year. And depending on what sectors you want to focus on, you can find stocks that cater to your criteria and either give you that increase in the dividend income or maybe a little less yield but higher appreciation over the long term. So for anyone who is deciding which one they embrace first, I would just look at your income situation. Do you need more money like now? It's important for you to have the money now. If so, an income dividend investing strategy where you are investing in companies like AT&T with super high yields makes sense. If you're someone who could wait it out and doesn't mind not making $1,000 per month in dividend stocks right away, something like a MasterCard would make more sense for you. The more stocks you look at, the more opportunities you'll have to finding companies that fit your criteria. I look for ideally a stock at around the 3% range with a 10% growth rate year over year in their dividends, because that gives me an idea that the company is still able to grow and they are still able to grow the dividend at the same time. Sometimes I do go a little out of bounds with that criteria, such as with a MasterCard, and I don't have AT&T, but if there is something that makes sense that has a high yield, it is something that I do sometimes consider. So think about what you want in a company. I think it really comes down to just a really simplified version. Do you want a current dividend aristocrat like AT&T, or do you want a future dividend aristocrat, one that maybe just recently started paying dividends and come 20, 30 years from now, they're going to be a big player in the dividend space? And the earlier you get into those types of companies, the better the long-term dividend payment and also the security of your dividend payment is, because I know in just today's market, there's a lot of suspensions, there's a lot of cuts, and just making sure you have something with a lower payout ratio makes it more likely that your dividend is going to be secure. I know some people think that, you know, the economy, I mean, the stock market is just going to go down at some point, and you could use something like dollar cost averaging to make sure that you're not putting all of your money in at a high point. But there's a lot of different ways you can navigate through what's going on. As long as you have an investing criteria, that's going to help you weather through any storm. And that's it for this video. I hope you guys enjoyed it. Smash the like button, subscribe if you want more like this. Until the next one, dream big, achieve greatness, and unlock your potential today.